Welcome to StokTok's deep dive into enterprise products partners. This is a master limited partnership focused on energy infrastructure, specifically the midstream assets that move oil, gas, and petrochemicals across North America. As of May 5th, the unit is trading at $38.50. The 52-week range runs from $29.68 on the low end to $39.74 on the high end, placing the current price near the top of that band. The 14-day relative strength index sits at 61.3, indicating neutral momentum, not overbought, not oversold. The 50-day moving average stands at $37.11, while the 200-day moving average is at $32.48. The price sits comfortably above both trend lines, suggesting an underlying uptrend has been in place. Let's work through the fundamentals, scene by scene, starting with a quick business overview. Enterprise Products Partners operates a diversified set of midstream energy assets, pipelines, storage facilities, processing plants, and marine terminals. The company moves crude oil, natural gas, and refined products across North America, and also stores and transports petrochemicals and specialty products. Revenue is generated through tariffs on volume moved through their systems, storage fees, and processing margins. The moat here is structural. Once a pipeline is built and integrated into supply chains, switching costs are high and capital requirements to replicate the network are substantial. The company benefits from long-term contracts with counterparties, many with take-or-pay provisions, meaning customers pay whether they use the capacity or not. The StokTok score across this name is 39 out of 100, marked as caution. Valuation scores a 7 out of 20. Financial health rates 9 out of 20. Profitability is 8 out of 20. Growth is 7 out of 20. And smart money positioning scores 8 out of 20. That aggregate score reflects a mixed profile, not an obvious buy, not a clear sell. Now, valuation. The question every investor has to answer: are you paying the right price? Enterprise Products Partners is trading at a price-to-earnings ratio of 14.37 times on a trailing 12-month basis. That's the most recent full year's earnings divided into the current stock price. Forward price-to-earnings comes in at 13.49 times, implying the market expects earnings per share to grow modestly in the coming year. The price-to-earnings growth ratio, or PEG, stands at 2.11. That ratio compares the price-to-earnings multiple to the expected growth rate. A PEG above 2 generally suggests the market is pricing in less growth than the valuation multiple would normally justify. In our view, that warrants a closer look at the growth trajectory we'll examine in a later scene. The enterprise value to EBITDA multiple is 12.91 times. EBITDA is earnings before interest, taxes, depreciation, and amortization, essentially a measure of operating cash generation. For a midstream energy infrastructure company with contracted cash flows, a 12.9 multiple is in the ballpark of historical averages for the sector, though peers such as pipeline operators and storage companies have historically traded around 11 to 14 times EBITDA, depending on leverage and growth visibility. The price-to-sales ratio is 1.65 times. That's the market value of the company divided by its annual revenue. From a discounted cash flow perspective, our DCF model suggests the unit is trading at a 2.83% discount to intrinsic value. That's a razor-thin margin of safety. Essentially, the market is pricing in very little room for error in the company's cash generation assumptions. Wall Street analysts have a consensus mean price target of $41, with targets ranging from a low of $35 to a high of $45 across 20 analysts. That mean target implies roughly 6% upside from current levels, modest and well within normal analyst forecast error. Turning to the most recent earnings quarter, Enterprise reported earnings per share of 63 cents against a consensus estimate of 64 cents, a miss on the EPS line. Revenue came in below expectations as well, though detailed segment breakdowns were not fully disclosed in our data set. The after-hours reaction was muted, with the unit falling just 0.2% following the release, suggesting the miss was already priced in or viewed by the market as immaterial. Market sentiment around enterprise products partners leans bullish, with a sentiment score of plus 0.35 on a -1 to +1 scale. That cautious optimism reflects analyst views that the stock has had a strong start, but poses questions about whether further upside remains available at current valuations. In our view, the valuation setup presents a mixed picture. The multiples are not egregious, but the margin of safety is uncomfortably thin, and the PEG ratio suggests the market may be overestimating growth expectations relative to the current price to earnings premium. Moving to financial strength, how solid is the foundation? The Piotroski F-score is a 9-point checklist of financial health metrics that collectively assess whether a company's balance sheet is strengthening or deteriorating. It ranges from 0 to 9, with 9 being ideal. Enterprise Products Partners scores a 6 out of 9, which places the company in the middle ground, not deteriorating sharply, but not demonstrating clear improvement either. That middling score merits scrutiny. The Altman Z score is a formula that estimates bankruptcy risk by combining profitability, leverage, liquidity, solvency, and activity ratios into a single number. A Z-score above 2.99 is considered safe. Between 1.81 and 2.99 is a gray zone of elevated risk, and below 1.81 signals high bankruptcy risk. Enterprise Products Partners scores 2.03, firmly in that gray zone. That doesn't mean bankruptcy is imminent, but it signals that the balance sheet bears closer examination. On the debt front, the company carries significant leverage. Cash to debt is just 0.03, meaning for every dollar of debt, the company holds only 3 cents of cash. That's very tight. The debt-to-equity ratio stands at 1.17, indicating that total debt exceeds total shareholders' equity by 17%. For a capital-intensive infrastructure business, that's not unusual, but it does limit financial flexibility. Interest coverage, the ratio of operating income to interest expense, sits at 4.86 times. That means operating income can cover the interest bill nearly 5 times over. In absolute terms, that's serviceable, but it's not a wide margin. If operating performance deteriorates, interest coverage could tighten quickly. The current ratio, a measure of liquidity that compares current assets to current liabilities, is 1.04. That's just barely above 1, indicating the company has just slightly more current assets than current liabilities do in the next 12 months. In our view, the financial strength picture is cautionary. The company is not in distress, but the combination of modest F-score improvement, gray zone Z-score, tight cash position, and moderate interest coverage suggests the balance sheet is constrained. There is limited room to absorb adverse developments without putting the company under pressure. Next up, profitability. Is this business actually making money efficiently? We begin with return on invested capital, which stands for return on invested capital. This metric measures how much operating profit the company generates for every dollar of capital it has deployed, both debt and equity. Enterprise Products Partners posts a return on invested capital of 10.56%. For context, the cost of capital for a company with this leverage and risk profile typically runs in the 8 to 9% range. And return on invested capital above cost of capital signals that the business is creating economic value. The spread here is modest but positive, which is good. However, it's not exceptional. The gross margin, which is revenue minus cost of goods sold divided by revenue, comes in at 14.18%. That's the percentage of each dollar of revenue that remains after paying direct production and transportation costs. For a midstream infrastructure business, where the core revenue driver is moving volumes through existing assets, the gross margin reflects the tariff income minus direct operating costs. The operating margin, earnings before interest and taxes divided by revenue, is 13.69%. That's quite close to the gross margin, indicating that selling, general, and administrative expenses consume very little of the tariff revenue. The net profit margin, which is net income divided by revenue, stands at 11.45%. This is lower than operating margin due to the weight of interest expense in a leveraged structure, another signal of how much debt constrains profitability. The free cash flow margin, which is operating cash flow minus capital expenditures divided by revenue, is 5.75%. Free cash flow is what's left to distribute to shareholders and debt holders after the company invests in maintaining and growing the asset base. 5.75% is respectable but not exceptional. It reflects the capital-intensive nature of the business. In our view, the profitability picture is steady but not compelling. The business generates acceptable returns on capital, margins are stable, and free cash flow conversion is reasonable. However, there is limited evidence of margin expansion or operating leverage that would signal improving unit economics or pricing power. Onto growth. Is this business expanding, and at what rate? Revenue growth over the trailing 3 years stands at negative 3.3%. That means annual revenues have contracted slightly on a compound basis over that period. Looking at a longer window, revenue growth over the past 5 years is 12.6%. The divergence here is telling. Strong growth 5 years ago has given way to contraction more recently. That's the profile of a mature infrastructure business that benefited from volume growth and new asset additions in prior years, but is now facing a more challenging growth environment. Book value, which is shareholders' equity, has grown at 3.9% over the trailing 3 years. That modest pace of book value expansion means the company is retaining earnings and reinvesting them, but at a rate that barely exceeds inflation. The stock currently yields 5.63% in dividends. For a master limited partnership like Enterprise Products Partners, that high yield reflects the structure's requirement to distribute substantially all cash flow to unit holders rather than retain it for growth. That yield is attractive for income investors, but it also signals that management expects limited capital appreciation. The returns come from the distribution, not from stock price appreciation. In our view, the growth trajectory is a material constraint on the investment thesis. The company operates in a mature, contracted market environment. Volume growth is challenged, and the business is not expanding materially. The positive 5-year number reflects a previous cycle that has already passed. The recent 3-year trend of negative growth, combined with modest forward earnings estimates, suggests this business is in the maintenance and distribution phase of its life cycle rather than the growth phase. Now let's talk smart money. What institutional capital is actually doing with this name? 13 top-tier investment gurus currently hold Enterprise Products Partners in their portfolios. These are portfolio managers with long track records of successful stock picking, the kind of minds that institutional investors pay substantial fees to access. The fact that Enterprise has 13 such holders is meaningful signal that experienced capital sees value here. However, we need to examine what those gurus are doing right now. Bruce Berkowitz of Fairhome Capital is the largest guru holder, with Enterprise Products Partners representing 12.19% of his portfolio. That's a significant allocation, a conviction position. Berkowitz has made no change to that position recently, holding steady. Leon Cooperman holds the stock at 1.46% of his portfolio and has recently added to the position, buying an additional 3.79%. First Eagle Investment Management also recently became a buyer, adding 3.57% to their holding. Thomas Gaynor of Markle Group has initiated a small buy. These recent additions from established investors suggest that smart money is finding the current valuation and dividend yield attractive enough to increase exposure. On the broader institutional front, 7.4% of 13F filing institutions, that's the universe of institutions with more than $100 million under management, are currently net buyers of the stock. In conventional institutional analysis, a reading above 50% would signal net bullish positioning. At 7.4%, the institutional base is predominantly neutral to slightly negative, with only a small subset aggressively buying. Insider ownership, which is the percentage of shares held by company management and board members, is 1.03%. That's very low. When insiders own very little stock, they have minimal financial skin in the game, which can reduce accountability and alignment with outside shareholders. In the past 3 months, there has been 1 insider purchase and 0 insider sales. A single purchase is a minor data point, but it at least indicates that someone inside the company believes the valuation is attractive enough to add to their position. In our view, smart money positioning is mixed. The presence of large guru holders like Berkowitz and recent ads by other quality managers suggests institutional recognition of value. However, the low level of insider ownership and the modest net buying from the broader 13F base suggests that not all smart money is convinced. And finally, the verdict. Let's bring it all together. On valuation, the stock is trading at modest multiples relative to historical averages, but the margin of safety is razor thin, and the PEG ratio suggests limited growth is priced in. On financial strength, the balance sheet is in a gray zone, not distressed, but constrained with tight liquidity and moderate interest coverage, limiting flexibility. On profitability, the business generates acceptable returns on invested capital and stable margins, but shows no evidence of operating leverage or margin expansion. On growth, the company faces headwinds with 3-year revenue contraction and only 5.6% dividend yield to offset limited capital appreciation prospects. On smart money, established gurus hold the stock and some are adding, but broader institutional net buying is minimal, and insider ownership is very low, suggesting limited alignment. The recent earnings miss on both EPS and revenue, despite the muted market reaction, reinforces that growth expectations are already constrained. The company reports next earnings on July 28, 2026, with consensus EPS estimates ranging from 75 cents on the low end to 83 cents on the high end, with a mean estimate of 79 cents. That upcoming report will be an important catalyst to watch. In our view, Enterprise Products Partners presents a mixed investment setup. The business is stable, the dividend is attractive, and several quality investors see value at current prices. However, the growth profile is challenged. The balance sheet offers limited flexibility, and the valuation leaves little room for error. This setup may appeal to income-focused investors seeking a stable yield in the energy infrastructure space, but it warrants caution for growth investors and those sensitive to balance sheet risk. Everything in this video is our interpretation of publicly available data, not financial advice. Please consult a licensed financial advisor before making any investment decisions. That's the deep dive on Enterprise Products Partners. Like and subscribe so we can keep providing you with no-nonsense, data-driven analysis of stocks. We will keep updating our videos as soon as new data that affects the stock becomes available.